All right, welcome back to the Annuity Researchers Podcast, where we provide unbiased reviews of annuity products so you can better understand how they work. I'm your host, Zachary Van Ness. Joining me as always, Matt Sluzer. We're both senior annuity advisors with Annuity Association, and today we will look at the Allianz 222 Plus. They've had a few changes recently, so we wanted to update our last review that we had of this product. And as always, what we'll do here today, I'll walk us through the brochure. In this case, it's actually a presentation by Allianz. We did some homework and we found that this presentation was a little bit more detailed. It had some more information in it that we found more valuable than the brochure itself. So we'll take a look at this, highlight the key features and contract mechanics. Then, as always, Matt will jump in, provide some insight on the index options as well as their function.
Hey, thanks for joining, everybody. I'm really looking forward to this one. But before we get started, just a couple quick disclosures. This episode is for informational purposes only and does not constitute legal, tax, or financial advice. The product features, rider options, and rates vary by state and may change at the insurance carrier's discretion. The brochures we reference today or presentations are not intellectual property of Annuity Association, and always make sure to consult with a licensed professional if you'd like to evaluate whether this annuity may be a suitable investment for your situation, goals, and objectives.
Yes, we jump into one of the big dogs here today that we might hear quite a bit about. I'm excited. This heads up, this is going to be detailed. There's a lot of moving parts with this annuity, a lot of benefits and features that come with it. So we want to review those and make sure there's a solid understanding behind this. And our main practice, of course, is to provide transparency and make sure that you understand what you're getting into when you're looking at certain annuity products. So with that said, we will dive right on in. Matt, can you see my screen?
I can. Thank you.
All right. Cool. All right, we'll jump on in here. Brief agenda, but we'll take a look at today. And as always, Matt will jump in, show us more information on the index opportunities and what kind of real-time performance we've seen in the past. So we'll begin by looking at the Allianz 222 Plus. That's the change that they've made. They used to be called Allianz 222, now called the Allianz 222 Plus Fixed Index Annuity, and what this can offer. So, as you prepare for retirement, you want control over how you create sources of guaranteed income. The Allianz 222 Plus annuity is a fixed index annuity, or FIA for short, that offers more control with some key features here. And this will give some definition to the name, and that's 2 ways to earn interest, 2 ways to earn a bonus to boost future income potential, and 2 ways to receive income increases. So we'll dive into that in more detail. As always, there are opportunities with fixed index annuities. I always appreciate when these carriers give some insight as to how fixed index annuities are used, and Allianz is doing exactly that here. So fixed index annuities can offer many benefits to you, such as accumulation potential. This is the potential to earn interest based on changes in an external index. Allianz fixed index annuities give you the choice of several indices as well as fixed interest option. There's also tax-deferred growth. You will not pay taxes on the interest the annuity earns until you take a withdrawal. This will help compound earned interest so that the money in the contract can accumulate faster. There's also a level of protection in the contract in that we don't have to be concerned about any loss and downturn of the market. Your principal is protected. Product also offers retirement income. Annuities are designed to provide a reliable stream of retirement income, either for a set period or for as long as you live. With this product, we'll see that feature. And lastly, fixed index annuities do provide a death benefit for your loved ones, which can be paid out in a variety of ways. So looking at the key benefits, let's begin by looking at the benefits of the Allianz 222 Plus Fixed Index Annuity can offer during the period of time at which you're saving for retirement. We all know people have varied financial objectives, all unique to them and their circumstances. Allianz 222 Plus can help meet some of those objectives, particularly for those who have a timeline of at least 10 years prior to retirement. So that being said, I want to jump in and give some color in that this product does offer lifetime of income. However, you've got to wait 10 years to activate that lifetime of income stream. Now, there are two bonuses to help grow the protected income value, or the PIV, as it'll be mentioned. A premium bonus, which will be applied immediately to that PIV and to all premium paid to the contract, and the PIV interest bonus factor, which will be applied to at the end of each crediting period. The protected income value is the value in the contract on which lifetime withdrawals will be based. This value is not available as a lump sum, and lifetime withdrawals can begin after at least 10 contract years. Beneficiaries have access to this value if it's paid as a death benefit over a minimum of 5 years. Now let's talk about the first of the two bonuses available with this product. First, to help accumulation for retirement, all premiums paid in the first 18 months will receive a 50% premium bonus credit to the protected income value. In this example, we're assuming that the contract owner has made a total of 3 premium payments in the first 18 months.
Just, can I add something to that, Zach?
Yeah.
So, I talk with a lot of people, and it seems like there's a little bit of confusion around the terminology where this is called a premium bonus. And the way that Allianz is defining it is it's based on the premium that you put in. They're offering this bonus, which is really added to the income benefit base. So essentially, the premium that's paid within the first 18 months, when Allianz is setting up this protected income value, that there is a figure they're calculating the income off of, that starting figure is 50% higher than the premium that was put in. And a lot of times when you hear this premium bonus term, it means a bonus that's actually credited to the principal account.
Yeah.
But one thing to clarify, this is not an amount that's actually credited to that accumulation value or that principal balance. It's really around the figure as far as how Allianz is calculating this income.
Yeah, that's a good call out, because I think it's common that we see a mismatch of how some terms are used in our industry, and one may use it in one function versus another. So that's a great point. The premium bonus is not directly a 50% added to the amount the applicant puts into the annuity.
Yep, absolutely. Good point. And it seems like there's confusion around that. So
yeah,
I think it's important to clarify that.
Yeah, good call out. Cool. All right. Now the second bonus, in addition to the 50% premium bonus, again, maybe put an asterisk on that term, premium bonus, each crediting period, a 150% interest bonus factor is credited to the protected income value. So, for example, if we select a certain index allocation and that chosen index allocation earns a 3% interest by the end of that 1 year crediting period, or whatever that crediting period is, it will receive a 150% interest bonus factor, which in effect becomes a total credit for that year of 4.5%. Now, on our hypothetical example, let's say the second year There is zero earned interest. No problem. Doesn't affect us positively or negatively. So let's say year 3, there is an additional earnings, and we can see that bonus that's applied. Again, 150% interest bonus factor applied here, giving us a total credit of 6% in that 3rd year. And this can help with the contract owner's income as well. So it's not just being applied to the PIV, it can also assist for the income. Now let's take a look at the hypothetical example of how the protected income value builds over time. So let's assume client purchases an Allianz 222 plus annuity with $100,000 premium payment. As we can see, the protected income value is increased to $150,000, boom, right there, immediately by the premium bonus. In addition, each year or crediting period, a 150% interest bonus factor is added to the protected income value in addition to the allocated interest. So the 150% interest bonus factor does continue after lifetime income begins. So you'll continue to earn that interest credited towards the income calculation after you activate the income. In this example, the first year allocation interest was 3%, multiplied by that 150% bonus, then that adds an additional 1.5%. So the credited PIV for that year would be 4.5%, or bringing our total up to $156,750. In year 2, again, is 0. So that does not change the value at all, doesn't affect us positively or negatively. Then in year 3, with that 4% hypothetical, we add that 150% bonus, giving us a credit of 6% to the protected income value, which would then in turn increase that value, also increase that income potential. So as you can see, the protected income value has the potential to increase each year until lifetime income withdrawals are started. And while you're accumulating for retirement, the Allianz 222 Plus offers access to a portion of your money in case you need it. So in the contract year following your last premium payment, you have the option to take out up to 10% penalty-free withdrawals each year. Plus, any penalty-free withdrawal percentage you don't take carries over to the next year up to a maximum of 20%. So as an example, if we take out 5% one year, that remaining percentage moves over to the following year. So the second year, you'd have the option to take out up to 15%. Now, you may never need it, but it's nice to know that that option is there for you. Now we'll jump into the key benefits while receiving that lifetime of income. So we'll take a look at this. The rising cost of living in retirement is a major concern, and the Allianz 222 Plus does offer opportunity for your retirement income to increase and help keep pace. So first, when you start receiving the lifetime income withdrawals from your annuity, after at least, again, waiting 10 contract years, there is the opportunity for the payment to increase every year or crediting period that the interest is earned. And once that payment goes up, the increase is guaranteed. So as we can see in this hypothetical example, payments increase in years 12, 13, 16, and 17 due to positive index credits. To give you additional perspective as to how the lifetime income withdrawals can increase, the hypothetical example illustration that we're going to look at here is based on $100,000 beginning in the 11th contract year. That would be the earliest that we could start the income. At the end of year 11, we see a total credited interest of 3%, and we factor in that bonus, and we can see that the income increases for that following year. Now, in this example, again, remember that there was no change to that index performance in year 2. We had a 0 return. So that income remains level, does not drop or go back to where it once was. The following year, a 5% credit. Again, we multiply that by the interest bonus of 150%. The income increases again, and we can see that continue. And again, if there's a year at which there's no interest credit, it does not drop. It remains the same. That's our new baseline. Another feature to this that's unique, and I'll have Matt hit on this a little bit as well, but the income flex benefit is designed to give you more financial flexibility to adjust unexpected expenses or life's what ifs. So starting in the first contract anniversary that you're available to begin those lifetime income withdrawals, so in year 11, you can choose to waive your income increase in any crediting period where there's an interest credit, and instead set aside an additional withdrawal amount called the income flex benefit amount. And you have the option to take a withdrawal from that amount at any point in the year, which can help with effectively managing finances during challenging times.
Yeah, this one's pretty unique. I can't recall coming across another annuity that had this type of a feature. Usually with the annuities with increasing income, they would have some measurement point where you have the opportunity for income increases. But with this, essentially, we talked about your income has the opportunity to increase 1.5 times any interest that's earned. And so as an example, if your index strategies had 5% interest during the year, then that next year, your income would increase 1.5 times that amount, which would be a 7.5% increase. And so with this particular annuity, you have the option that you either could take that income increase or you could waive that next income increase. And essentially that rate that your income would have increased, they will apply that to the accumulation value in the annuity, and you could take that as a lump sum in addition to that year's income. And in that same example where the income would have increased 7.5%, let's say that there's $100,000 in the accumulation value, you could take out $7,500 as a lump sum. And, I could see that where that would be a benefit to maybe somebody that they're getting ready to replace their air conditioning unit or have some kind of a large expense that's coming up. And instead of funding that from other sources, they could just forego that future increase to their income, take that lump sum out, and go ahead and handle that project or whatever the unforeseen situation that's come up. So that is I could see a value to that, certainly. Now, keep in mind that if the accumulation value starts to come down, you've been taking income for a long time. Once that accumulation value is very low or goes to zero, then that would no longer be available if that account is depleted.
Yeah, great point. And I think it goes to show there's some awesome features that come with it, but the number of features and opportunity that there's some management that comes along with it as well, because it can be pretty easy to forget all the tools that you have inside of this, because there's a lot of opportunities here. All right, so there's our added income flex benefit. Another benefit that we've got, income multiplier benefit. Now, the Allianz income multiplier benefit is another way to help alleviate some of the rising costs during retirement. After lifetime income withdrawals have begun, the benefit allows clients to double their payments by qualifying in one of two ways. If the contract owner is confined to a qualified nursing home, a long-term care facility, hospital, or assisted living facility for at least 90 days in the consecutive 120 days after the first year, or if the client is unable to perform 2 out of 6 activities of daily living for 90 consecutive days, they would qualify. Now, in the hypothetical example that we see here, the withdrawal prior to the illness is $20,000 annually. After meeting the criteria, the payment doubles to $40,000. And as you can see, it still has the opportunity to increase during the indexed interest being credited to the contract. So the benefit does continue until either the client recovers or the accumulation value reaches zero, upon which the payments revert back to the standard payment. You don't lose them, they just go back to where they were. And just as a quick note, a physician does need to certify the covered person is unable to perform these activities of daily living. Just keeping in mind, again, needs to be for at least a minimum of 90 consecutive days. So another feature that we've got here. In this next section, we'll discuss some additional features and details, and this will be the index lock feature. Now, once we start pivoting to how these index performances can affect the account, the income amount, the PIV, the protected income value, now we can see the index functionality behind that and how it can be utilized. And there are some unique features here. That index lock feature gives you the flexibility to track and view index values online and initiate a lock and lock it in and a value selected index interest allocation at any time during the crediting period. So as an example, let's say we have a 1-year crediting period. This feature allows you to lock in your earned interest at any point in that 1-year period. So this can help minimize the effects of a midterm market volatility while also providing the opportunity for positive index credits. The index value used to determine interest credited may be higher or lower than the index value at the time of request. So looking at this, there are 2 ways that we can activate an index lock. The first is an automatic trigger where we can use an auto lock feature. We simply set the index interest rate percentage you wish to target. You can set both an upper and a lower target as long as you set them above or below the current index interest rate percentage. Now, if your interest allocation options index percentage reaches the target, the auto lock will automatically lock in that index value until the contract anniversary date. So it will credit on that contract anniversary date. It will not credit prior to. You're also free to adjust the target index interest rate percentage either up or down or as many times as you wish during that auto lock option. The second way is that you can activate an index lock, and you can do that manually. So if the lock has not already taken place, simply request a manual lock anytime within the crediting period. Both options make it easy for your clients or for anybody to receive a positive index credit in a volatile market. So in looking at these functions, you can credit this automatically by setting it, or you can manually do that, and that might be communicating with your advisor or doing that online. And this is where Matt's going to jump in here later on. He's going to talk more about these index options that we have to choose from and take a look at some of the real life performance. One other factor to consider is that there are 2 ways to take a death benefit. So with the Allianz 222 Plus annuity, this does offer beneficiaries the choice of a lump sum death benefit equal to the full accumulation value, or they can choose to take the full protected income value as annuity payments over at least 5 years. So in this hypothetical, using $200,000 premium and assuming the contract owner passes away at the end of the 4th contract year, the beneficiary would have 2 choices. Number 1, they could take the greater of the accumulation value, the cumulative withdrawal amount, or the guaranteed minimum value as a lump sum. In our example, $212,180 accumulation value is the greatest lump sum value. If no interest has been credited, the lump sum value would have only been $200,000, the initial amount. or they could receive $327,607 protected income value, and you'll see that in option number 2, as annuity payments over a period of at least 5 years. So keeping in mind, this has to be spread out over at least 5 years. In the hypothetical example, again, we're assuming $200,000 as our single premium up front, keeping in mind that we get that 50% premium bonus and 150% interest bonus factor and a hypothetical 3% index interest. A lot of moving parts. Now, if no interest had been credited during the life of that contract, that would have been a $300,000 protected income value for a death benefit. So just note that if lifetime income benefit withdrawals have already begun, then the beneficiary would receive what's remaining of that value, not the full or highest value.
Can I add to that, Zach?
Yeah.
So the way that I see this annuity positioned in a plan is really someone that maybe they have most of their essential income from guaranteed sources already in place, and they're planning. This is a performance-driven annuity where the initial guaranteed income amount is fairly low relative to some of the other options in the marketplace, and it has a long waiting period of 10 years. And during that deferral phase, based on the index performance, that income benefit increases. And then once the income starts, it has further opportunity to increase based off of interest that's earned. And so this is really in a plan for that long-term tail of income or income stream that has some increasing capability to address inflation later on during retirement. But it's not, when we look at the index options, we'll see that they're fairly modest in their performance. So this is not an annuity that's geared strongly towards accumulation. It's more that long-term income. But what is nice about this enhanced death benefit is someone that they're delaying the income for a long time. If that owner passes before they see the benefit of that income stream, and their balance maybe has been more modest in how it's grown, this is where there's that chance for that enhanced death benefit, so that additional value could go to their family if they didn't really get to realize that full value from the income stream. And so that's where I see this as kind of that protection, where maybe you have a little bit of trade-off on the growth side, but there's still an enhanced death benefit if you were to pass before you realize the value of that income.
Yeah, no, it's a great point. And it's kind of this hybrid vehicle where we're getting some positives in different areas and putting them all together into one annuity. It's just finding the best way to use it. That's a great point. Awesome. Just some additional product details for reference. The issue age of this policy is anywhere from 0 to 80 years of age. The minimum premium that can go into this policy is $20,000. That could be qualified or non-qualified funds. Again, we had mentioned the free withdrawal ability, so up to 10% greater of the total premium paid, and up to 20% max if that 10% was unused in the prior year. Flexible premium, so ability to add additional funds in the first 18 months. There are index options that may have a charge. There are many index options that don't have a charge, so you've got the choice there. Accumulation value, you'll see some of these key terms as well. The accumulation value is the value that you would receive if you took all of the money as a lump sum, if you were to take that full amount out without any withdrawal charge penalty, or after the withdrawal charge penalty. Cash value, so if you chose to cancel the contract during the first 10 years, by the way, you can see right below here the chart of the surrender schedule and what those charges would be. But if you were to exit the contract anytime in the first 10 years, you would receive the accumulation value minus the withdrawal charge and adjusted by the market value adjustment, which we see right below. So the market value adjustment, this is the withdrawals in excess of the free withdrawal provision. Any withdrawals in excess of that free withdrawal provision are subject to a market value adjustment during the withdrawal charge period. And that withdrawal charge period is that 10-year period, of that contract. Protected income value, the PIV, determines the amount of lifetime withdrawal income that you would receive. And that PIV premium bonus and interest bonus factor are applied to that protected income value only. By the way, there are no fees for this product in terms of a lifetime of income. So when we look at the comparison of lifetime of income annuities, this is one that wouldn't have a fee associated to it. And that will walk us through that and show us what the marketplace looks like in comparison. Right.
Yeah, thanks, Zach. I'll go ahead now and pull up our software. So if you've joined us before, you know that we utilize a software that sorts the entire annuity marketplace, so we can see where this 222 plus stacks up relative to other options that are out there. And when I pull this up, I'll be using an example of a 60-year-old male in Florida. Now, keep in mind that these rates are subject to change at the carrier's discretion based off of, unless an application's been submitted to lock in the rate. And also the rates and availability could vary by state. So if this is an option that you're exploring, please make sure to consult with a licensed financial professional to see what your rates and availability are in your state, and if it's a suitable investment based on your financial situation, goals, and objectives. And so let me share my screen here. All right, can you see that, Zach?
Sure can.
So this is our income calculator that'll sort all of the fixed indexed annuities in the marketplace based off of the highest guaranteed income. And so we're using the example of a 60-year-old male in Florida with a $200,000 investment. And this is our deferral bar, where we'll show how many years of delay before the income starts. So this particular annuity has a 10-year waiting period. So we're going to go ahead and move that out to 10 years of delay.
Also, as a quick note, not only that, but if I recall right, the income cannot start until the client is 60. Is that right?
That is correct, and it's either covered life. So that is a very important point to note, because sometimes you have, a married couple where one of the spouses are younger, and so the youngest covered life has to be at least 60 in order to start the income. And so with this example that we're looking at, we have a male starting at 60 that would be actually activating the income at age 70 in this case, because typically we see this really as that long-term income to help to protect against inflation later on in retirement. Mm-hmm. And so we have a couple different options that we can sort in our software, but to start, we're looking at no income reduction. So this is sorting the very highest guaranteed lifetime income amounts. Now the Allianz 222 Plus is more performance driven, where it starts off at a lower income amount, and then based off the performance of the index strategies, it'll increase. But as we look at this, we can see what are the very highest guaranteed amounts that have guaranteed growth, not that performance driven aspect. And so with this particular scenario, Equitrust is the highest at $34,672. And we have several options here in the marketplace: Clear Spring, Delaware. This is just to give us an example of what are some of the fully contractually guaranteed income amounts, not including that performance driven nature. And so we can see right now 34,672 is the highest, but we can flip over now and just compare the performance driven annuities that have some aspect of, either performance helps to grow the income during the deferral period and or once the income starts. And so typically these will start off a bit lower relative to the ones that have full guaranteed growth on the income benefit. And so if we evaluate the performance-driven annuities to get more of an apples to apples, we can see that North American, their Benefit Solutions 10 is showing up as the highest guarantee, 29,409. And this particular one, based off of the interest earned from the index strategies, that income has the opportunity to increase. But let's continue to see where the Allianz 222 Plus stacks up. So there's a couple of variations of the same annuity from Delaware that's pretty high on the list.
And these all have, does the North American have a fee? Oh, it did.
So yes, the ones, typically the higher the guaranteed income is, that's where the fee would come into place.
Yep.
So especially the ones that do not have the rider fee. So you can see in this example, 1.2% income rider fee for this annuity that gets deducted from the accumulation value, and it has a higher guaranteed income. These do as well. So as we go down the list and that minimum guaranteed amount is a bit lower, we will eventually see the fee drop off. So as we go, so here's a couple without a fee from B++ rated carriers, Atlantic Coast Life Insurance Company and Sentinel Security. And then essentially the 222 Plus, it's tied for the 12th on the list here in terms of highest guaranteed income. And it's right here next to this annuity. The Agility through Athene is probably the closest competitor to this 222 Plus. So they're structured very similarly. The 222 Plus, so in this scenario, $200,000 investment, delayed out 10 years. The minimum guaranteed income amount is $16,500. And as we discussed, that amount, as you delay and earn interest, that'll grow. So all of these variables on the right-hand side are related to that income benefit. And so we can see there's the 50% income-based bonus, which means in this example of an investment of $200,000, Allianz will start the calculation on the lifetime income based on an amount that's 50% higher than what was put in. So we can see with the $200,000 initial investment, they are going to calculate the income as far as that minimum guaranteed income off of $300,000. And then they apply a age-based payout factor to that. And that's how they arrive at this $16,500 figure. But we also discussed that as you're deferring out that income, 1.5 times the rate of interest earned will increase that benefit. And so you can see here where it talks about this roll-up rate of 150% of the interest rate. And that growth is available up to age 95. And so we also see here there is that 10-year waiting period. So you have to wait until you've gone through the full initial 10 years before you can activate income, and that minimum age would be 60. And so really this is, if this is a vehicle, think like a car, the index options, that's the engine, that's what's going to be driving the growth. And so the index selection is very important because the initial guaranteed income is relatively low when we compare that to other options in the marketplace, but it has substantial ability to grow during that deferral period. So let's take a look at the index options that are available. And so this is a list of all of the index options available, and you have the ability within the annuity to select multiple index options. You don't have to put all your eggs in one basket. You can have an allocation. And this is what will drive the growth. And so what we're looking at, these are 1-year annual point-to-point strategies with a participation rate. And so what this means in this example of this blended futures, they will look at what is the price of that index at the beginning of the year and what is the price of that index at the end of the year, that contract year. And if it's positive, whatever that positive amount is, they would apply this participation rate to that and credit interest to the accumulation value. And so this figure on the right-hand side, this is showing the back-tested 10-year average annual return for this particular index. And that is net of the impact of what your participation is in that upside. But as an example, so if this particular index were to be up 10% during the year, then 50% of that, or 5%, would be credited as interest to the amount allocated to it. And so we can see, as far as these back-tested returns, this one showing over the most recent 10-year period that would have been 6.73% average annual. Now, one thing that's important to note is that some of these index options could be relatively new. So there's been a lot, these are risk-controlled index options, a lot of them, and they're typically a combination of some equities along with a fixed component. And if the equity side is too volatile, the index will shift more into the fixed side to smooth out those returns and protect the downside. And due to enhancements in technology over recent years, there's been many of these that have come onto the scene. And essentially, if an index is relatively new, then the company that created it, based on the components within it and the rules of how it operates, they'll project what it would have done had it been around for a full 10-year period. And that's where we like to not just look at the back-tested returns, but look at real time. How has this index performed? How long has it been around? And how has it done since it's gone live? But as far as these index options, so this blended futures, this is a combination of US and international equities as well as 10-year treasuries. Now, this one is a very new index, and actually there's fairly limited public information as far as on its performance, ticker symbol, things like that. So it really doesn't have the full visibility yet because it is so new. And so that's an important step. If we were going to consider that as part of the allocation, we would want to be able to see as far as how long has it been operating and how has it done. But on these other ones, in just a moment, I will pull up the actual live index performance so we can see how long have they been operating and how have they done since they've been live. This particular index is based off the S&P 500 futures. It's a excess return index. And then we can see this Morgan Stanley strategic trends. This one actually has the NASDAQ futures excess return index as well as a fixed component. And this one adjusts the allocation based off of interest rate trends. And then we have the Bloomberg US Dynamic Balance 3. So this one combines a combination of the S&P 500, NASDAQ 100, Russell 2000, as well as a fixed component. And so this is a risk-controlled index, so it would have just a very small portion allocated to the equities. And if the equities are very volatile, it'll shift a bit more heavily into the fixed side. The PIMCO Tactical Balanced Excess Return Index, so this one has a U.S. equity component, and then it also has the PIMCO Synthetic Bond Index. And then we have several variations of the S&P 500. So there's a S&P 500 monthly sum with a cap, where essentially each month during the contract year, any positive performance of the S&P 500, they would track that up to a 1.7% ceiling per month. And then any negative months, they would include all of that in the calculation and then add up all 12 months. And if that sum is positive, then they would credit that interest to the account. If it's negative or flat, you just would remain at zero for that particular year. And so this one, if the market was steadily increasing, so if you had a 1 year period where there wasn't a ton of volatility, it was just a steady rise, then with this monthly cap, this one has some pretty strong upside potential in that scenario. But if there's a lot of volatility, such as this year, where back in April we had a large drop in the markets, then that could negatively impact a strategy like this. The next one is the S&P 500 point to point with a cap. It has an annual cap of 5%, so they'll track from the beginning of the year till the end of the year. Was the S&P 500 positive? If it is, then you would get interest credit from anywhere from 0 up to that 5% ceiling. And there's also a performance trigger strategy. The current rate's 4.25%. So this would be if the S&P 500 is positive at all, it could be positive 1%, 2%, or 20%. They would credit a flat 4.25% interest. And then last but not least, on the 1 year strategies, the same Bloomberg US Dynamic Balance 3 Index is available with a different strategy that's called the highest daily value. So in an annual point to point, the risk could be maybe for the first 3 quarters of the year, the index is doing fantastic. And then as you get towards the end of your year, maybe there's some volatility that hits and you start to lose some of that ground that you've made up. So this highest daily value, it protects against that happening by essentially setting what is the high water mark for the entire year. And they would compare that highest daily value to where the index started the year and credit interest off of that. But you can see in exchange for that high water mark within that same index, just the annual point to point is 90% of the upside of that index versus the high water mark is half that amount. So there's a bit of a trade-off in terms of that strategy. And so those are all of the 1 year strategies that are available. Also with many of those index options, they also have a 2 year point to point strategy where they'll measure what was the performance over that whole 2 year period in credit interest. And there's a 5 year term. And so what do you get for going out those longer terms? They offer quite a bit higher participation rates. So you can see this PIMCO, for example, if we go up to the 1 year strategy, the 1 year strategy gives you 85% of the upside of that index, versus if you go out the 2 years, it gives you 135%. And if we went out 5 years, it gives 235%. So really the longer those index strategy terms are, the higher the participation. And we can see how that impacts these back-tested returns. Now, the trade-off on that is that if you see that through to the end of the term, in this case 5 years, then you're waiting that full 5 years to receive your interest credit. Now, with this index lock feature, though, this annuity gives you a lot of control where if you're happy with the performance of your index, even if it's in the middle of the year or middle of a 2 or a 5 year term, you have the ability to lock in those gains, and that interest would be credited at the end of that contract anniversary. And for these longer 2 or 5 year terms, if you exercise that index lock, you would then be able to reallocate those funds to a new index strategy at the beginning of that next year. So there is some flexibility, but you can only exercise the index lock if you have positive performance. So if you were in a 5 year strategy and the first year the index was down, you would have to ride that out and wait for it to come back. You are not able to lock in a negative value. And then last but not least, there's also a fixed interest strategy. So if you don't like the idea of having your interest tied to the index strategies, you can actually select a guaranteed interest rate current rate is 2.8%. It has a 0.1% minimum guarantee. So this essentially gets declared each year, and it's 2.8 right now. That following year, it could be a bit higher, it could be a bit lower. They guarantee over the life of the contract the fixed rate would never go away. It would never go to zero. So that's what this minimum is. All right, so those are all of the index options that are available. Now let's take a look and see real time how these indexes been performing, how long have they been around. So I'm going to pull that up. Now, keep in mind, these figures we're looking at, these are the raw index performance figures. They don't include the participation rates. And also for any of these index options, if you see a negative performance, keep in mind within a fixed indexed annuity, your principal's protected, so you don't have any exposure for potential market loss. And so here is a list of all of these index options that are available. Can you see that clearly, Zach?
I can, yep.
Perfect.
Yeah, so as an example, like you had mentioned, this being raw index performance, just to be clear for anybody listening or viewing this, if we chose the S&P cap, I believe that S&P cap was at 5%, was that right?
Correct, yes.
So if we chose the S&P cap on the 1 year return, how that index option would have performed in a 1 year point-to-point strategy. Right now, if it were 1 year from today, that's showing a 12.5% return on the raw index performance. But what I would be credited as the consumer, having a cap at 5%, my cap, my earning would be 5% for that 1 year.
Yes, correct. Yeah, so this is showing the raw performance of the index options. And so there's caps or participation rates where there's a certain amount of that upside that would actually be credited. But really the point of this is to look at, have these indexes, how long have they been around? Have they been performing positively? And so the first would be the S&P 500, which that's been around since 1957. We can see, especially in recent years, been doing very well. And there's several strategies in the Allianz annuity. There's the annual point-to-point with a cap. There's the monthly sum with the cap. And there's also the performance trigger strategy based on the S&P 500. There is the S&P 500 futures excess return. And what we're looking at here, so these are the returns year to date. And then we can see the 1 year performance. We can see the 3-year average, 5-year average, 10-year average, 2023, 2024, and since inception. And now in the since inception, in the case of the S&P 500 futures ER, so there's not a date in here in terms of since inception, but if there's not a date, it means it's been in operation at least over 10 years. So all of these numbers that we're looking at, this is live performance. Now, if we go down and look at the Morgan Stanley Strategic Trends 10 ER index, that one's relatively new, so it just came out in July of 2024. And when we look at, so it has a little over a year of live performance. So if we're looking at the 3-year, the 5, and the 10, those are back-tested returns that are hypothetical. And so we can see, as far as year to date, it has performed positively, and over a 1 year period, it looks like when it had first come out, there must have been a little bit of a dip because the average since it's been live is 0.46%, but for the 1 year, it's up 2.7. So there's a little bit of a downturn there during that initial window from July to November with that particular index. So overall, since it's been live, it's been relatively modest in performance. And we can see over the 1 year period, pretty modest, 2.7%. And that particular index, you get a participation in that, so not a full 100% of that performance. Bloomberg US Dynamic Balance 3. So this has been around over 10 years. You can see live performance over the 10 years, 3.95%. Some of these risk-controlled index options that have that fixed component, they have somewhat underperformed over the last couple of years because the markets have been a touch more volatile than typical, and also the fixed markets haven't necessarily they've underperformed relative to some of the other asset classes. And so we see that when we see that the most recent period over the 1 year is very modest on that, but it does have fair performance over a 10-year period. And then we look at the PIMCO Tactical Balanced Excess Return Index. So again, as I mentioned, the last year, these types of index options have underperformed. But when we look at since inception, so it came out in 2018. So this has been around for, a little over 7 years. So most of this back-tested return is live performance. And so we can see over the last 5-year period since inception, this particular index has performed positively. All right. Zach, you have anything else to add to this one?
No, that's good.
All right. So now let's put it all together and look at, we talked about the guaranteed minimum income for this particular scenario, a 60-year-old male in Florida, $200,000 investment, delayed out 10 years. We saw that the guaranteed minimum was $16,500 a year. So let's take a look at a hypothetical and see, with interest factored in, what could that income look like? And so I have an illustration here from Allianz. Now, we'll look at a couple charts on this, and let me pull this one up.
Yeah, well, Matt's pulling that up just as a reference for you. So normally we're not pulling up carrier illustrations, but because there's more moving parts here, especially with the performance-driven aspect, we wanted something straight from Allianz to give a direct correlation.
Yeah, thanks for that, Zach. And so we'll look at a couple charts. There are 20 pages in this illustration. There's very important definitions. There's disclosures in here. So if this is a particular annuity that you're reviewing, you definitely would want to receive the full 20 pages and go over that very carefully. But we'll look at a couple examples in here. So as we discussed, this is based off a $200,000 investment with a single life income, male, 60 years old, and that income is delayed out 10 years. So this is showing income starting at the beginning of year 11. And for this, I've selected the S&P 500 annual point-to-point with a cap. So that means that each year, any positive performance of the S&P 500 up to that 5% cap would be credited as interest. And so we can look at a couple examples here. So this first chart is showing a hypothetical if that S&P 500 with the 5% annual point-to-point cap, if it performed like the most recent 10-year period, and that gets projected out moving forward. So we can see that this is assuming a $200,000 initial investment. And then this particular column here, end of year credited interest rate, this is where they're taking the most recent 10-year back-tested performance and they're projecting those forward. So we know over the last 10 years, there were a couple of years that the S&P 500 had negative performance. So in this chart, that's where you're seeing the years that have zero. And each year that it was positive, it would have been over 5%. So since this has a 5% cap, that's why you're seeing those flat 5% interest credits. The next column over is showing the principal account or accumulation value. And so with that $200,000 initial investment, there's no fees with this particular annuity, and there's no deductions we can see from that balance before the income starts. And we also see as interest is earned, that interest is credited. So in the example of year 2, there was 5% interest credit. So that balance increased by that 5% interest. Now, these other columns in the illustration, this is showing end of year pre-market value cash value. We did talk about that this annuity has a 10-year surrender period, and if you cancel early, and you don't qualify for an exception, there's 2 factors that come into play. There's a surrender penalty, and then there's the market value adjustment. So this column is just showing that if you canceled within the 10-year period, you can see that this balance is less than the accumulation value because it's factoring in what that cash value would be minus the surrender penalty. So in this example, once you get past your full 10 years, then you would have the option where if you surrendered the policy, you would have no surrender penalties or market value adjustment. So you can see at the end of year 10, these 2 numbers match up. Now the third column is because that extra element is the market value adjustment. And essentially that market value adjustment, it's not known what that could be, but what this minimum guaranteed value does is it essentially puts guardrails if there was a worst case scenario market value adjustment and you were to surrender early. What is the guardrails around the maximum penalty? And so that's showing what the minimums are. And once you get past the 10-year period, then you would be able to surrender for the higher of these 2. So in this scenario, at the end of year 10, the surrender value would be this higher amount, 281. So now these last 3 columns are getting into the lifetime income benefit. And we talked about there's this protected income value figure, which is the figure that Allianz uses to calculate the lifetime income. And there's a 50% income-based bonus. So we can see if there was an initial investment of $200,000, that starting figure for calculating the income would be $300,000 or 50% higher. And then any interest that's earned, this protected income value is going to grow at 1.5 times that rate. So in year 2, we see that there's a 5% interest credit. 1.5 times that would be 7.5%. So this income value is increasing by 7.5% during that year. And we can see the same thing for the next year. If there's interest, that protected income value will grow. And that would continue on as you delay it out. So in this hypothetical example, instead of $16,500, which is the minimum guaranteed income, that income has now grown to $27,374. And once that income begins, any interest that's earned, so in year 12, we can see there's 5% interest earned, and that income would grow at 1.5 times the interest earned, so 7.5%. So that next year, that $27,374 now grows to $29,427. So it increased by 7.5%. And moving forward, so in this year 13, it's showing there was interest earned, so that income increases that next year. But if there's 0 interest, then there just would be no increase that following year. Now, one piece that's very unique about the Allianz products is that this particular annuity is really geared more towards the income more so than the accumulation. And we can see that the growth on the accumulation value is somewhat modest, right? And so because that income is a pretty competitive amount and it's increasing, you would expect in an annuity like this that if you've been taking income for a decent amount of time, that at some point your accumulation value will go to 0. Now, a lot of the annuities out there that have increasing income, if your accumulation value goes to 0, you do not have any further opportunity for increases to your income. But in the case of many of Allianz's products, even if the accumulation value goes to zero, you still have the opportunity to track those index strategies and have the opportunity for your income to keep growing. So that's a unique piece here. So we can see in this hypothetical, even though that accumulation value is zero, we see increases to that income. And one other example to take a look at, so this protected income value, if the owner were to pass, the beneficiary would have the opportunity to take this protected income value over at least a 5-year period. And I mentioned that's really to protect against if, perhaps this owner, before they really saw the benefit of their income, they passed somewhere during this initial 12, 13 years. And so in this case, at year 11, we see that the accumulation value is $254,046. So if this owner were to pass, the beneficiary could take that as a lump sum, or they could take this $449,301 over at least a 5-year period. And so essentially this does have a maximum. So it's a max of 250% of the premium paid less any withdrawals. So there is a ceiling on this. It's not unlimited as far as what that enhanced amount could be, but you can see here though there's some additional value in that protected income benefit that the beneficiary would be able to take over a 5-year period. And so that is the first hypothetical based on the most recent 10-year period. And then they have another one which are pretty similar figures. This is using the most recent 30-year period as far as these hypothetical interest credits. So we can see in this case fairly similar figures to the last chart that we looked at. And at the end of this, as they're going through, there was 200,000 that was initially invested. If we look through age 90 is where this chart goes out to, there would have been total income withdrawals of a little over $1 million. And then the last chart for us to take a look at, this is what is the bare minimum contractually guaranteed amounts. So this is an example if the markets were down every single year and there was no interest earned, what is that worst case scenario? Now this is not practical because over a long period of time, there will be interest earned. If the markets were really down each year, there is a fixed interest option that's available that you could select and get a guaranteed interest rate. But this is just showing with no interest factored in, what do the numbers look like? And so the main takeaway here is that there are no fees coming off of this accumulation value. There is some enhanced death benefit here from that bonus, not including any interest that's earned. And we can see that the minimum guaranteed income without the interest factored in is $16,500, and that is guaranteed for life even if the accumulation value depleted. So these types of performance driven annuities, they start off with a much lower guaranteed income, and then that grows based off the index performance, which we looked at those scenarios a little while ago. And so that's really all I had on that one. We took a look at where this annuity stacks up in the marketplace and what index options are available to earn interest and grow your accumulation value and your income benefit. And then we looked at some scenarios as far as how does that come into play? What do those numbers potentially look like?
Yeah, that was a great review. I know this is definitely more detailed than most of ours. So, and looking at that, just understanding that with this annuity type, lost myself, there we go. And with this annuity type, there's a lot of moving parts to it, a lot of features and benefits that add a tremendous value. Ultimately, my takeaway for a product like this is that for a client looking and finding a product like this that's useful to their plan, working with a professional who communicates, who is there and is willing to be hands-on is probably the most paramount thing to find when we're looking at something like this. This is not a set it and forget it. And in our opinion, with annuities, no annuity technically is a set it and forget it, because there's ongoing maintenance, whether that's address change or information updates that may be needed. Just keeping in mind that this specifically is definitely not a set it and forget it annuity. So it's important that you have an active advisor working with you just to maintain your annuity's performance and optimize it to the best ability. With that said, I think we've beat our record time here in a product review. So this is a breakdown of the Allianz 222 Plus. Keep in mind, if you are looking for a better way to explore annuities, one built around transparency, education, and helping you make a confident, informed decision, we'd be happy to assist. So whether you'd like to speak with one of our annuity specialists or connect directly with Matt or myself, you'll find a scheduling link in the show description. Now you can also request a personalized annuity report tailored to your specific goals. So whether you're focused on protection, guaranteed income, or a balance of both, just follow the link in the description to get started.
Yeah, thank you again for tuning in. If you found this helpful, please like and subscribe. And if there's a specific annuity product that you'd like us to review, please leave a comment, let us know. And until next time, we're the Annuity Researchers. Thanks again.
See ya.